The year 2026 has ignited with an electric atmosphere in global markets. Asset prices are roaring, fueled by a potent mix of technological enthusiasm and aggressive bets on future policy easing. Yet, beneath this glittering surface, the real economy is sending troubling signals of fatigue and dislocation. This paradox, a high-stakes divergence between bullish financial momentum and deteriorating macroeconomic fundamentals, is the central challenge investors must now navigate. The collision course is set, and the coming weeks will test the conviction behind this powerful rally. To understand the current market landscape, we must first appreciate the profound divergence between what the market is pricing and what the economy is producing. The narrative is split, with investor sentiment driving a full-throated, risk-on rally that sees U.S. small caps surging plus 5.73%, European equities gaining a strong plus 2 to 3%, and even gold breaking decisively through $4,520 an ounce. This synchronized advance suggests investors are betting aggressively on future policy support while shrugging off geopolitical noise. As a jarring counterpoint, however, the U.S. macro data reveals significant labor market softening. The latest Nonfarm payrolls report was a stark miss at just plus 50K, a figure made worse by downward revisions of minus 76K to prior months, while the manufacturing sector remains mired in a slump, with its ISM index at 47.9. Broadening the scope, persistent structural drags haunt the global economy, from China's exported deflation, where producer prices fell minus 1.9%, to the Eurozone's sticky services inflation, which remains elevated at 3.4%. This market has priced in a perfect soft landing, making the upcoming inflation data a critical test of this widespread optimism. The headline numbers of a market advance only tell part of the story. To truly gauge its durability, we must analyze the quality and composition of the rally, as this reveals investor conviction and highlights potential vulnerabilities. The most telling signal has been the powerful outperformance of the Russell 2000, which surged plus 5.73% last week and has rallied approximately 14% over the last 6 weeks. This marks a significant rotation towards value-oriented and smaller capitalization companies, suggesting a broadening of market participation beyond a narrow group of leaders. Further evidence of this improved breadth comes from the equal-weighted S&P 500, which outpaced its traditional market cap-weighted counterpart. This indicates that the rally is no longer solely dependent on the magnificent tech giants that dominated performance in the recent past. Powering this rotation is a tangible shift in sentiment. The Michigan Consumer Sentiment Index rose to a 4-month high of 54.0, providing the emotional fuel for the soft landing narrative that underpins this entire rally. While the rally's foundation appears healthier and less concentrated, its very survival depends on an economy that is showing undeniable signs of fatigue. While investors celebrate broadening market participation, the real economy is sending a clear reality check. The Federal Reserve's restrictive policy, designed to cool inflation, is now visibly inducing a slowdown, particularly in the most interest rate sensitive sectors. The evidence of economic weakness is mounting. The disappointing December non-farm payrolls report showed a meager gain of just plus 50,000 jobs. More alarmingly, downward revisions to the 2 prior months erased a further 76,000 jobs from the record, confirming a rapidly cooling labor market. This is compounded by a severe slump in manufacturing, where the ISM PMI has now been in contractionary territory for 10 consecutive months,
falling to 47.9. However, the picture is not uniformly negative. The services PMI, a gauge of the larger part of the U.S. economy, surprisingly hit a 2025 high, driven by a rebound in new orders. Furthermore, targeted policy support, such as a $200 billion mortgage bond purchase plan, has provided a significant lift to home builders. This resilience in services and housing creates a split-screen economy, where interest rate-sensitive sectors are buckling under Fed policy, while others show surprising strength, complicating the path forward. This very tension confirms that the Federal Reserve's higher-for-longer stance is finally cracking the labor market, a development that, paradoxically, validates the market's aggressive bets on future rate cuts. This tension between a weakening economy and market hopes isn't just in the labor data, it's creating paradoxical movements in other asset classes as well.
In a healthy market, assets typically behave according to established correlations. However, when assets that normally move in opposite directions, like gold and stocks, rally in unison, it signals a complex and potentially unstable environment driven by overwhelming liquidity. The surge in precious metals is a key indicator. Gold has soared past $4,520 an ounce, while silver has decisively broken the $80 per ounce level. This is more than just momentum. It represents a strategic hedge by investors against the risk of currency debasement from future easing or a sudden geopolitical shock. Simultaneously, credit markets are exhibiting robust strength. Long-end Treasury yields dipped modestly, and both corporate and municipal bonds outperformed, buoyed by a combination of light supply and solid investor demand. The core insight from these parallel rallies is clear. Abundant liquidity is acting as a rising tide, lifting all boats. However, the smart money is not merely riding the wave of risk assets, it is simultaneously buying insurance, hedging its bets against a potential and sudden spike in volatility. This theme of conflicting signals is not unique to the U.S. Similar dynamics are playing out across the globe, starting in Europe. Europe finds itself caught between a nascent industrial recovery and a persistent inflation problem, creating a formidable policy dilemma for the European Central Bank, ECB. On one hand, there are tangible green shoots of growth. Major indices like Germany's DAX plus 2.94% and the broader STOXX 600 plus 2.27% posted strong gains. This was underpinned by surprising strength in the continent's industrial heartland, as German industrial production rose plus 0.8% and orders surged plus 5.6%, defying expectations of a slowdown. Most encouragingly, headline CPI for the Eurozone fell to the ECB's 2.0% target. On the other hand, stubborn friction complicates the picture. While headline inflation has cooled, core services inflation remains elevated and sticky at 3.4%, a key concern for policymakers. Regional fragility is also evident, with UK housing data showing prices dropped 0.6% in December. This challenge suggests that due to this persistent services inflation, the ECB's anticipated easing cycle could already be over. While Europe battles inflation, Japan is grappling with a very different problem born from its currency. A weak currency can have a paradoxical effect on an economy, creating an illusion of prosperity while quietly eroding the real wealth of its citizens. This is the core tension defining Japan's economy today. The data presents a stark contrast. Household spending is up, a strong plus 2.9%, seemingly pointing to a robust consumer.
However, this is occurring while real wages have simultaneously fallen by negative 2.8%. This divergence is the weak yen effect in action. The mechanism is straightforward. The yen's slide to 157.6 yen per US dollar provides a massive tailwind for the country's exporters and boosts the Nikkei, plus 3.18%. But it simultaneously erodes the purchasing power of Japanese workers by making imports more expensive. In response to this dynamic, Bank of Japan Governor Ueda is signaling a path of continued rate hikes to stabilize the currency, a move that presents a difficult and delicate path toward policy normalization. If Japan's challenge is managing a currency-fueled boom, China's is dealing with the exact opposite, a deep-seated and dangerous lack of demand. China's economy is currently defined by a stark internal contradiction. Its stock market is gripped by a speculative frenzy, largely detached from the grim, deflationary reality reflected in its fundamental economic data. The market frenzy is undeniable, with the CSI 300 index gaining plus 2.79% on the back of soaring AI enthusiasm and rising margin debt. This speculative rally, however, is built on a fragile foundation. The economic fundamentals tell a story of profound weakness. Producer prices, or PPI, have been in deflation, falling another minus 1.9% and marking the 39th month of decline. For the full year, CPI inflation registered 0.0%, the lowest reading since the financial crisis in 2009. This divergence has trapped the People's Bank of China, PBOC. Policymakers know they must ease further to combat deflation and repair structural demand, yet doing so risks fueling the very asset bubble they seek to contain. This global tour of economic contradictions sets the stage for a week where these narratives will collide with hard data. The week ahead promises to be pivotal. The upcoming data releases are not merely routine reports. They represent a verdict on the market's entire soft landing thesis. Tuesday's U.S. CPI report stands as the anchor event, poised to dictate the immediate direction of global bond yields and the U.S. dollar. From there, traders will be laser-focused on a series of interconnected challenges. A hot U.S. inflation surprise could violently reset rate cut expectations, while a subsequent miss in retail sales could confirm that a genuine consumer slowdown is underway. Across the Atlantic, fresh data from Germany threatens to confirm a deepening stagnation in Europe's industrial engine, with reports on UK GDP and China's trade balance providing further crucial signals on the health of global demand. Volatility is all but guaranteed as the market is finally forced to reconcile its fervent optimism with undeniable reality. The year 2026 has begun with a bang as market momentum powered by tech enthusiasm, a healthy rotation into small caps, and falling headline inflation has driven returns across global equities. This optimism, however, faces significant friction from a real economy where labor markets are cooling faster than expected, and China remains a deflationary anchor on global growth, creating a wide and growing gulf between financial asset prices and the performance of the physical economy. The verdict is that markets are currently priced for perfection, a flawless soft landing combined with aggressive central bank rate cuts. The upcoming U.S. CPI and retail sales reports will serve as the truth serum for this narrative. The collision between momentum and reality is imminent, and a miss in either direction could spark the sharp repricing this market has so far managed to avoid.